Hello and welcome. For today's interaction, I'm joined by my colleague Chirag and Resham Jain, fund manager at DSP Mutual Fund. He co-manages the mid and small cap funds at the fund house along with Abhishek Ghosh and Vineet Sambre. Welcome, Resham.
Hi.
Thank you for taking time for this interaction. Now, to begin today's conversation, why don't you start with, sharing with our viewers what got you interested in equity investing?
Yeah, so I think I landed up here. Frankly speaking, I have changed my professions multiple times in the last 15 years, and actually that is helping me. I started being in academics to start with. I used to teach, and then I moved to corporate finance. I worked in a manufacturing company. I looked at various aspects of finance over there. And from there, I moved to the sell side research, tracking several sectors. And then finally, from last 8 years, I am on the fund management side, looking at several sectors plus the fund responsibilities as well.
Okay, great. Now, both the funds that you manage, that you co-manage, what is your exact role there? How are the three of you organized to manage this one?
Yeah, so if you look at the journey of DSP Small Cap Fund per se, this fund started way back in 2007-8, and it has completed almost close to 17 years now. And over a period of time, the fund size kept increasing. So let's say a decade back, the fund size was close to 3,000 odd crores. Now it's close to 13,000, 14,000 crores. So with the size, the amount of stocks or the number of stocks which also increase, and that leads us to get more people in so that we can share responsibility. And obviously, at a portfolio level, all of us sit together, discuss what need to be done in the fund. But then we can go more deep dive into specific areas between us. So that is how all three of us are involved in the fund. I look at specific sectors in more depth. For example, chemicals, agri, some of the retailing companies, and like that, a few more smaller sectors in small cap universe. And I go more deeper into that. And Abhishek goes more into in some of the other sectors like building material, logistics, and few other sectors. And obviously, we have a large research team as well, which support us on specific sectors. Vineet is a seasoned fund manager, has a significantly longer experience than us, and hence both of us in a way assist him in a lot of areas.
So basically, Vineet takes the final decision whether a particular stock should be in the portfolio or it should be exited from a portfolio.
Yeah, it's you can say because his experience, that experience helps, but it's a co-decisions, I would say.
Okay. Resham, another thing was, you have been in the equity markets for about a decade, as you said. And how has the transition been from a research analyst to a fund manager? And what are the most important lessons you have learned as a research analyst?
So I think whether it is a fund manager or a CIO, I think everyone has a bit of research analyst in them, and that will never go. One has to get into specific sectors. One need to understand the nuances of the companies, of the sector, and that's the core of investing, I think. So the obviously what has happened is over a period of time, looking at one sector, two sector, and now multiple sectors, and that expands your horizon. So maybe the biggest lesson is that when I was looking at one sector, I sometimes you understand that sector, and you don't look at what others or what else is looking good, and then within that sector you love one or two companies. But then when you look at multiple sectors, you then feel that okay, that sector itself is not good, or it is very good. So that way, I think the biggest learning is that sometimes you don't go and look at companies within the sector, but you look at sectors itself. And it is possible that many a times we completely ignore that sector because of the particular kind of nuances of those sectors, which are not conducive maybe they are very cyclical in nature, or maybe it's very difficult to predict earnings for those sectors, or every few years there is a kind of leverage which builds in those sectors. A regulatory kind of issues happens in those sectors. So there can be multiple issues. So I think that's the biggest learning. You need to be thinking, especially from a portfolio perspective, whenever you think from an incremental stock perspective, don't just look at stock within that sector, but look at across the sector whenever you want to add incrementally to the portfolio.
You joined DSP Mutual Fund in 2016, and from 2018, around from March, you have been managing the DSP Small Cap and the DSP Midcap Fund. So what has changed in around 5.5 years you managing the fund?
I think the first principle is to have your framework right. I think in last 5-6 years or maybe more, and obviously I've imbibed some of these core principles from Vinith as well, and those principles haven't changed. So maybe your sector, company, markets will change, but you have your core principles of having a growth-oriented company, having a right ROE, having a right balance sheet. So all those, I think, main quantitative as well as qualitative factors on having a good management, having less or marginal kind of or governance issues should be less in those companies. So I think the core principles, and we have written a document also in 2018, that remain core. That hasn't changed. Obviously, AUM has changed, and some of the learnings also is that when you go big or grow large, you need to have more concentration in some of the stocks which you like, which you have more conviction on, and that is what we have done. So in both the funds, if you'll see, as you rightly mentioned, the number of stocks have actually come down. Also, what has happened is the market capitalization itself has changed over a period of last 5 years. Small cap, which used to be like 6,000-7,000 crore at that point of time, has now moved to 18,000 crore. So your universe has also increased. So that has also helped in a way in this whole journey, basically.
Was it easier 5.5 years ago to manage the fund, or is it easier now? As you know, as the market have expanded and there are lot more opportunities in buying the stocks.
Frankly, nothing is easy. It's always difficult. I would not say difficult, but I would say you need to work for the right set of sectors and companies. What has happened in last 5-6 years is that you have to be more agile in the way, because the volatility has increased not only within domestic market but globally also, and hence your ability to quickly move around between sectors and companies becomes very critical. This in context to our core principles of buy and hold, you would see that in our turnover ratio, which is significantly lower than peers. So for us, it becomes even more kind of prudent to identify right set of sectors and companies, because we are not going to change it more often. Also, with the size of the fund, we need to respect that churn also, because it's not easy to keep churning. In a smaller size fund, it's easy to churn your portfolio, and the impact cost was not that higher. But now with a larger size fund, that becomes much more important factor, and hence whenever you buy or sell a stock, you need to be more convinced about it and then take a call. So I think those are, I would say, an important thing which would have changed during this period.
All right. So you mentioned that the universe itself has increased and, the AUM has changed and one needs to be agile and all of that. But what are the constraints, what are the key constraints while managing the mid and small cap funds?
So I think there are few important changes or constraints, or I would say, which are important. So first is, let's say, the sectors itself are emerging. There are new sectors which are emerging, and there are no history to those sectors. So I was talking about chemical earlier. So chemical, there were only few companies, very less history. More and more chemical companies came. Each of the chemical company has different kind of products which they sell, and it had global history. So we need to go back to global companies, see what they have done, how they have done. Secondly, also what has happened is that the global environment has also, in a way, changed in the last 5 years or so. We could see there are a lot of kind of quantitative as well as qualitative barriers which has been imposed in the sectors, and that further creates a kind of imbalance in the trade globally. So you need to understand global factors while understanding local industry. It might be having domestic sales only, but it might get impacted with what is happening in terms of global prices. And at the same time, if it's a global company, obviously it will have multiple implications. We have seen a good amount of advantage to India in this global kind of scenario. China plus one, Europe plus one. A lot of reliance on domestic manufacturing, which led to this PLI related schemes. So I think a new set of companies have emerged. It's not a constraint, I would say, but what happens is you need to understand that sector with a different lens where you don't have an history. And in an Indian kind of scenario, how would it play out, and how would Indian promoters react to some of these global changes? So I think that I would say in the last 5 years, I would classify this to be a kind of challenge for the analysts per se in understanding those sectors.
Also, small companies, they do carry promoters' risk. So, what extra diligence do you exercise when it comes to the small cap stocks?
Yeah, so among various parameters which we look at specifically for small cap companies, management do play a very important role. I would say I think the first thing is the number tells you the story. So if you look at last 5 years, 10 years, numbers of the company, it will tell you the conduct of the company, the conduct of the management, the promoters in a way, how they've allocated their capital, how prudent they were, how disciplined they were in using those cash back into the company or paying dividends. I think the discipline on working capital, the discipline on leverage, those are the parameters I think that helps us to, from number itself, rather than going and speaking to them, that will tell us the story. Secondly, obviously, we do detailed kind of meetings with the companies per se, and try and understand what they do, how they do, what is their philosophy. That also gives us a sense of their thought process. Third thing, what we do is we also do a lot of plant visits. We do a lot of other checks, and that also helps us to understand the culture of the company. We speak to multiple layers of management, so we can get a disconnect if there is any between how the promoter thinks or the management thinks versus the other people think. In addition to this, we do a lot of channel checks in a way, speaking to vendors, speaking to customers, speaking to maybe past employees, speaking to peers. This all helps us in gauging of the ethics, conduct, governance of a specific promoter. And I think we have to be, there is no one single parameter or a single principle which will work here. But I think all this in a combined way helps us in evaluating management in a better way.
Okay, and you mentioned that the AUM has changed, since you joined, it has gone up significantly. So is the big size a deterrent, or it gives you ample opportunity to look for more number of stocks?
So obviously at this point of time, we don't see that as a constraint. We see enough opportunities emerging. And as I mentioned, the small cap definition itself has changed. So company less than 6,000 crore was small cap, let's say 5 years back. Now less than 18,000 crores. So in a 6,000 crore company, I could take, let's say 1% stake, it would be 60 crores. Now in an 18,000 crore company, a 1% stake would be 180 crores. So I think we have to see how the market has also evolved over a period of time. That also in a way helps, and hence I don't think that is a constraint. Also getting more hands to get more deeper and getting, let's say, higher weight, even in case if we are doing that, that also helps in a way. So from a, bandwidth perspective or from universe perspective, I don't think there is any constraint at this point of time.
Resham, another thing, just wanted to understand, how do you access the growth potential and the competitive advantage of mid and small cap companies? When and what kind of stocks became a compelling buy for you?
So I think generally people perceive small cap, mid cap companies to be very small, tiny companies. They might be eaten away by larger companies. I think I would like to say some of the small cap, mid cap companies are like leaders in their space. And it's not like they are leaders from last 3 years or 5 years. They have been leaders from last 10 years. And so, for example, a tile company would be a small cap. Most of the companies will fall under the small cap universe, and the leader there is a company which we hold in our fund, and they have done phenomenally well. I think what and there are a lot of other sectors like this where a 1,500 crore revenue would classify it to be a leader in the country. So I think there is no challenge as such. There are a lot of sectors where we could see Indian companies are competitive, not only within the country but globally as well. And not only just on the labor cost. That's how people think when it comes to Indian companies, but it is also in terms of technology. It is also in terms of, let's say, a lot of consumer companies have distribution edge. A lot of companies have the culture edge in the way they manage the culture. For example, the whole service industry, the IT industry, which has evolved over the last 30 years, it is basically low cost resources one, but that advantage was with many companies, but only few companies emerged because the way they manage the culture and the employee and the HR policies over there. So I would say that there are a lot of opportunities in this space, and with the kind of growth which we see in the country right now, and specifically in the consumption space, I would say, and I would like to highlight here, because the lifestyle changes which we are seeing is significant because of, let's say, more urbanization, a more nuclear family being there, the kind of digitization which is happening. So the overall behavior of a consumer is also changing. So we have a lot of we have almost like 40-50% weight, which is in a way consumption. I would say not just FMCG, but different kind of consumption in the country. And we see a lot of companies in the small cap, mid cap space falling in this universe. And we are very excited with this kind of story or potential they have in future years.
Resham, I just wanted to understand, how do you select the stock from the given universe of the fund house into the small and mid cap set? What are the parameters which you look while choosing the stock in the portfolio?
So obviously, we have this simple principle of getting or selecting right business, right management, and a reasonable valuation. Having said this, I think evaluating business is the most important element there, and obviously changes depending on each sector. And then obviously, if we get into specific sector, then we evaluate multiple aspects about it. First and foremost thing is the opportunity size. Is the sector showing growth year on year? And then obviously drill down on the companies, whether that company has specific advantages to grow in that industry and what competitive edge they have to be a winner in that particular game. I've talked about all those things, whether it is technology, cost, distribution, brand. It could be various aspects. So we try and analyze those aspects. Obviously, a lot of industry also have a constraint of capital. Maybe in that sector, a new entrant may not be able to do because your initial upfront investment itself is very large. Many times, it also happens that the competitive advantage could be, let's say, the complex nature of the business. So, for example, we have few companies both in mid cap, small cap, which is into dairy sector. It looks very simple. You collect milk, distribute milk. But imagine this has to be done every single day. You cannot miss a single day of this operation. You have to collect 2 times in a day from the farmer, morning and evening. You have to get it logistically come to the processing center, and then from there you have to get to the main center. From there, you need to distribute to multiple touch points. So you can imagine the complexity of this business. You collect from like lakhs of farmers and you distribute to lakhs of customers in a way. And you have to do it 365 days, 24/7. You have to be there in the field. So it's not an easy business. It's a very, very complex business. At the same time, it is a business about trust. You will not buy milk of any brand. So in case if you have cracked this complexity of operations, but if you don't have a brand, still you can't win the game. So I'm just giving an example just to explain that some of these businesses are very, very complex. So you need to get to the root cause or the overall business model. So I think there is a whole lot of quantitative as well as qualitative framework which we have while selecting a particular sector and companies. And then obviously management and valuation are the other parameters which we look before investing in the company.
Since you manage DSP small cap and mid cap funds, and more or less, compared to large cap, they are quite different compared to the large cap. So is the strategy different in managing the funds, or is the same selection process? And what are the different matrix you use by choosing the small cap stocks or the mid cap stocks in that particular portfolio?
No, I think if one has to look between small cap, mid cap, large cap, I think selection process ideally should remain similar in terms of coming to a specific company. Our mode of selecting companies are largely bottom up. Obviously, we think top down in terms of how that company fits into that top down approach. But I think one big differentiation I would say between the kind of market caps is that getting in and getting out is not easy in small cap names typically. And hence, automatically, you have to think long term. You can't think about next quarter and next year. You have to think beyond that because, and many times we like if company comes down or the stock price comes down because we like those companies. We feel it's a bargain to get into those companies at that prices. And many times we want to increase our weight, but maybe we are waiting for right price. So I think the biggest differentiation between the market caps is you have to think long term. And hence, not just us within small cap, probably we'll be having lower turnover, but as a small cap industry or small cap fund industry per se, overall they'll have a lower turnover ratios compared to the large cap funds. So that would be the biggest differentiation.
Is there a portfolio overlap in both the schemes? Because market cap is more or less little bit higher on the mid cap side. So is there an overlap in the portfolios?
There is some overlap between the portfolios. I think 17-18% last, which I remember. But I would say the overlap has, since the SEBI definition has come, I think there is a clear demarcation now. And the overlap is not very significant because the fund manager is same. There could be some overlap between the two because we have liberty to buy 35%, which could be outside the kind of market capitalization. 65% has to be mid cap in mid cap fund and similar for small cap fund. So, and obviously because there is a 6-month reclassification which keeps happening, we don't restrict ourselves to 65. We try and keep it higher so that reclassification doesn't impact us and compels us to change our portfolio frequently. I think ultimately it's about generating returns, and both funds should get a fair kind of treatment when it comes to earning returns. So if we think that it has the right metrics and a portfolio construct to be added in that particular scheme, for example, we may already have a dairy company in mid cap, and we may have a lesser weight in small cap. Then we will try to manage it maybe through a small cap company in a small cap fund, and maybe with a mid cap company in a mid cap fund.
All right. Now, presuming you're a growth investor, since you manage the mid and small cap funds, given this scenario, what kind of stocks do you like? And, if you could tell us which are the ones that you would never buy?
So I think one of the key principles, and in our investor deck also, we are clearly highlighted. I think selecting right kind of stock is there, but there are certain stocks which we typically avoid. There are certain kind of characteristics which we don't want to have in our fund. So, for example, companies having significantly higher or questionable, let's say, related party transaction. We will never have those kind of companies in our fund. Or let's say sectors where there is a significant amount of governance issues. Uh, so we will not have in our fund. Uh, Sectors which are, let's say, highly cyclical. There is a differentiation between cyclical and highly cyclical. So we may not have very high weight of those kind of sectors in our fund. Sectors, for example, where we see a very frequent changes in regulations, and that impacts the profitability or the business profile of the company. We would not like to have such companies in our fund. For example, organizational structure, which is very complex with many subsidiaries, let's say 100 subsidiaries within India, outside India, it's very difficult to analyze those companies, what they are doing, how they are doing. So we typically avoid such companies which are highly complex in terms of their organizational structure. So I think the avoid list is very clear to us. We will never invest in those companies. We would like to have companies which has good history, obviously, and obviously at different point of time we have different likings in terms of sectors and themes. For example, at this point of time, the way India is growing, and I've talked about the consumption part. I think I like the discretionary spend part a lot. There is a change in the way consumer is consuming, and for example, we have a lot of companies which is home improvement side, kitchen, tableware, furniture, consumer durables. So I think the way we are consuming at home also is changing, and that's how our portfolio is designed. Let's say in small cap per se, a lot of companies are there in that space. For example, infra, we are liking some of those big themes which are emerging, whether it is in oil and gas, power, water, road, green tech. So there is within infra, I can bucket companies into multiple subsectors, and that is another thing which we like. Another thing which we like is whole manufacturing space per se. I talked about PLI earlier, so I think chemical, textiles, pharma intermediaries. So there are a whole lot of sectors where there is a huge focus by government on the manufacturing space. So like that, we like certain themes, and then we drill down on what companies to invest in those particular themes.
So, Risham, you just mentioned in the small cap and the mid cap, and you look at the long term because there are certain constraints, and so obviously you have to look at the holding the stocks for the long term. So, just wanted to understand how long is your holding period of stocks? Don't you have any targets or exit to exit or trim the position? I'm asking you because I just went to the portfolio and I found it. The small cap and the mid cap fund has around 30 stocks and 15 stocks respectively you are holding since you started managing the fund. So just wanted to understand, when do you exit a stock, when do you trim the position, or where don't you have any price targets?
So yeah, I think this has become more important in the current times, when valuations are getting stretched, and we respect valuations. At the same time, sometimes we love the companies and management, but I think respecting valuation is important, and we have trimmed our weights. Sometimes we have exited names also when we don't think the kind of valuation they are trading at are not justified. So we are very prudent on those fronts. You could see a lot of stocks which we have bought as a micro cap have actually become large cap over a period of last 10 years. And at some point of time, we felt that valuations are becoming too stretched, and we have exited them. Another reason why we sell a stock is also because we have our initial thesis of a specific company, that it has to behave in a specific manner in the terms of progression. And some of our thesis doesn't work out the way we have initially thought. And we give enough time. We think patience is a virtue. but at the same time, it should not be classified as laziness, because you tend to give more time and then you feel sometimes that your thesis is completely broken. So we take proactive calls there, do our channel checks, and then finally exit those names as well, maybe at a loss as well if our thesis doesn't play out. So I think both valuation, respecting valuation, and stock not doing well could be the possible reasons why we exit some of the names. Also, governance issues. While when we enter the stock, many times everything looks good, but over a period of time, management does certain things which may not be correct or in the best governance practices, and hence many times we sell the stock. So I think that's a usual portfolio kind of construction process for us.
Your funds, the mid cap as well as the small cap, they've gone through a rough patch in the, over the last few years. So what has gone wrong and how do you plan to improve the performance?
So I think some of the improvement is already visible in the last year or so. And I think the long-term performance is still good in both the funds, small cap and mid cap. But I think the biggest learning for an intermittent kind of underperformance, and sometimes it's good not to react, because you might be right, but maybe market might go through a different kind of cycle. But at the same time, you need to keep asking questions whether whatever portfolio construct you have is correct or not. And obviously, in the last 2 years, we have course corrected whatever is required. And I think a few of the not I would not say mistake, but I think learnings is that you have to be proactive. I talked about the changing environment, which makes us to change the sectors much faster than probably earlier we would have required to do. I think that pace has increased for sure, and I think that is probably, I would say, the biggest learning. But otherwise, I think core philosophy remains same. We have seen similar kind of intermittent underperformance during 17-18 as well. We haven't changed our portfolio much during that period of time. Our performance came back. I think at this point of time, we had to tweak a little bit, which we have done. And I think last 1 year is a good kind of outcome for us to feel that whatever we are doing is correct.
You spoke about it, but can you just get more elaborate on what are the factors which has not worked for the fund in the last 2 or 3 years?
So I think some of the sectoral calls have not performed the way we have thought. And some of those same stocks which led to underperformance actually did quite well this year. And hence you would see those same stocks have actually given us the return. So probably some of the thesis played out, but with some delay. Also, some of the theme which we didn't thought that will pan out the way it might have done. So, for example, defense, we have companies in our fund, but probably we were a little late. Or, for example, during COVID, you would see IT stocks, the way they have performed. The previous 5 years, 7 years were not that great for IT companies. And we took some time to build our positions over there. So maybe again, that led to some underperformance. But I think if you stick to your core principles without changing it very frequently, I think otherwise what happens is you keep changing every now and then, and your core thesis doesn't play out. So it has worked out for us from last 17 years with a good performance overall. So I think we'll stick to those principles going forward as well.
Resham, lastly, recently DSP has announced an NFO for the small cap passive fund, small cap 250 50 index fund. And if we look at the data, we found, the active and the passive, for example, the DSP small cap fund, both have given equal returns, for half of the time, passive fund has outperformed, and for half of the time, small cap active fund has outperformed. So just wanted to understand, why should investors invest in the active fund, where there is a more cost or the returns are more or less similar compared to the index funds?
So I think most of the funds, I'll not say just DSP Small Cap Fund, DSP Small Cap Fund has outperformed benchmark over a very long period of time under different cycles. But at the same time, industry as a whole, I think if you look at large cap, mid cap, small cap as a fund, active funds as a group, overall, more number of funds have outperformed benchmark. And this is more important in small cap where quality and more deep dive into the companies become more important. And hence active becomes quite critical over there. So I think I would say that active mostly has done very well as a group in the small cap universe. So yeah, I think, but at the same time, I think within small cap universe, if you try and apply certain models into it in terms of quality benchmark and other stuff, I think you can at least screen better than the overall index. I think what we have launched is on the similar lines. And there has been a back testing done on it and stuff like that. And obviously there is an analysis on that. But yeah, and there is a group of investors who are not investing at all. I think passive fund would be a first beginning to those investors. And you could see only 3.5-4 crore folios of investor. There is a whole lot of investment people who are required to invest in this long-term wealth creating products. Passive would be a best way, less complex product to invest in to begin with.
All right. Thank you, Resham. Time for us now to wrap up this chat.
Thank you so much.
Thank you.
Thanks.